Hi, everybody. Just here to talk a little bit more about how to make money and just going over my trading style and discussing it with you guys. I talked about trading events, and that is a really good general strategy, if you want to call it that, or a system, but it's pretty vague. And in particular, the events I'm talking about are the events that a publicly traded company has to report its earnings for that quarter, and then once a year they do an annual report. And so these are like special moments when otherwise not public information is made public, and the price can vary as a result depending on how the company is doing. Uh, they're like a window into the company's operations, right? And so I have this rule of thumb where I try to find about 5 companies a week. Sometimes it's less, sometimes it's one, sometimes it's none, but generally that's my goal. That's what I aim for. And I dig into those companies, and I am focused on finding out if I think that company has done really well in the preceding quarter. And so if will the report reflect like a strong quarter, and will the price uh, vary as a result? Will it go up? And in some cases, everybody has already done this for a certain company, and they already expect the price to go up. So, because to a considerable extent, stocks are determined by supply and demand, and by general expectations of the stock trading public and the financial news media and analysts and all of that, aka the market. Uh, if there's already a large expectation of a change, that's considerable. It has already been priced in, as they say, or the expectation is already there. In which case, you will often still do well, and strangely enough, quixotically, or if you will, uncannily, often, like very often, even if the general trend that's forecast is correct, the magnitude is not exact, and there are a lot of reasons for that, but it's an opportunity if you believe that like I'm going to give you a very simple example, and this has occurred multiple times. Like Apple has always had profitable quarters, right? Going back as far back as we can remember, especially after the iPhone and iPod and the new Apple. But not every quarter that has been forecast to be profitable has been forecast to be as profitable as it really was. So there was always opportunity to make money, and then it's all about like the belief you have, and it's pretty low risk. If you were to buy trading options on an earnings call is a little bit more risky, and that can be very profitable too. But what I think is a good way to start out, and how I do what I do on like a lot of stocks, is just to buy and hold, and the stock can go up 5%, 10%. If there had been an option if there had been an option play and the stock had moved up 15%, I would have made much more, of course, but I would have also lost a lot if it didn't move enough. And there's a lot of implied volatility in the earnings event like calendar. When there's an event announcement, then an event occurs. So options can like very quickly just like go down almost all the way to zero in value even if the price goes up and you've bought a call, and you're near, let's say you're close to the strike price. The price is getting close to your strike price. That is. If it's not quite there yet, and you have to be like exact, it's like roulette a little bit. You have to be exactly on the money. In some cases, like on many things in the stock market and finance and investments, there's a lot of variations, and it's really hard to give like always applicable like advice. But this is general observation. So there's a little bit more risk, but I like to trade stocks that are a little less well known, a little less commented on, and I mean I'll discuss them as they come across, and I don't think it's fine. Like I don't think it's really a problem for me to do that in terms of like it will actually change the price. But the more like the less leeway, the less crowded like a trade is. In some cases, the more money you can make. But also you have to be careful because you do not want to buy a stock on and before the earnings, let's say, and it's not a well-known stock, and the earnings are positive despite whatever analysts assigned to that stock have said. Let's assume they said it was going to be negative or no change or something of that sort, but it was really, really positive. Great, suddenly there's going to be a lot more interest in that stock, and if you just bought it, you're probably going to make a lot of money, like 15 to 20%. Easily, in many cases, that's happened. But if you were to buy options on that, like low volume stock, hopefully you'll be able to sell it off and load off. But there are cases in which, unless you're like got the right option with the right strike price and everything, even if you're generally correct, it's a little harder to like sell them, even if you were correct in your prognosis for that stock. But either way is good, and I like to actually do both at the same time. So I can show you. So you just get like a calendar in like 5 days. Look at this is all publicly available information. Look up any 5 days that you want. So a good rule of thumb is to like a month ahead, because you do not, in general, it's a little riskier to trade a stock that is just about to have a public disclosure, like a public event for like an earnings call, just because a lot of people have probably been trading it already, and the price starts moving correspondingly in the weeks leading up to an earnings call, even if the earnings call is going to be great and surpass everybody's expectations, and then the stock goes up like 30%. Leading up to that, generally people can tell it's going to be fine. It's going to be a nice stock that week. The earnings call is going to be good, even if they don't know exactly how good it is. So it'll go up maybe like 10% the week leading up. And then the day of, if it's just spectacular. And this occurs, more often than you think. This happens like all the time. Stock goes up another 30%. So if you're really, really clever, you want to get in like 3 weeks before. And for whatever reason, there's like a cutoff. People have short attention spans. The week or two leading up, it's like it starts going up. But 3 weeks, same stock, same quarter, and nothing's really changed. The stock will just be fine. It'll be like normal. And then, so you get in there, and then it starts going up. And then here, if the earnings are just like normal, it'll usually still stay up, because they expect like a normally positive earnings, like 5% or something. So it'll go up 5% or something if they beat expectations, but like they don't beat them by much. But like I said, oftentimes they beat them by a lot. And this happens all the time. And suddenly you got all that profit built in. You got that 10% leading up to the earnings call, and then you've got that 30% on the day of. If you've bought options, you're doing like really well here. You're doing possibly like a couple 100% gains, at least like 40-50% gains if you bought the right kind of option. Even if you've just held the stock, which is safer, and I always think that's like a really good way to do it without worrying about options, because the options are a whole different consideration for you to have, like different types of calculations. Even if you've just bought the stock, now, wow, that's 40%. Okay, every week if I'm getting 40%, I'm going to be really rich in a short amount of time. And so that's plenty. That's nice. That's a good day's work. So the trick, such as it is, or like the work is like finding the stocks here and there. And that is somewhat difficult, but it's really, I think, if there is a good stock, it's obvious. If it's not obvious to you, then that's the work that you have to bring yourself to the point where it's obvious to you. And you shouldn't do a trade, or I really avoid trades where something is not obvious to me, where I don't see the logical, progression of steps that, this is obviously going to do really well in this quarter, in this context. Because, some stocks I might think, okay, this stock's going to do well, like in the unspecified time frame going forward. And that's different than, will the stock do really well, or has it done already really well? Has it already done really well this quarter? And you just get like 1 or 2 of these every week. That's enough. 1 a week is enough. 1 a month is enough. Let's play like a little game. $1,000. Let's say your stock has gone up 40% with the whole like procedure, and then we just described. Awesome. 40% gains on $1,000 stock, $1,400. Okay. And if you're organized and you're doing your work every week, you're doing this. So now 40% on 1,400. All right, bring that up, and then on and on and on. And the next thing you know, you have like $10,000 in like 4 months, maybe less. And then you keep doing it. That's the beauty of financial profit and like stock markets, and you can always reinvest what you have and just keep going. Is it risky? I would say it's really not that risky. I mean, oddly enough, because, theoretically, if you're making money, there has to be a risk, but I don't see the risk. The risk is there's a risk of catastrophic stock market-wide failure. You got bigger problems than whether you made your 40% that week or that month. Should you, people always say, oh, okay, it's just a little bit of money, but it builds up. It does build up. I've made a lot of money from a little bit of money, and I've done it in some cases just for experiments, like put $100 in an account, turn it into 1,000. Like put $1,000 in an account, turn it into 10,000 or 100,000. And this is first of all, it keeps you sharp, and it's fun, and I think it can really be like, it can help people. It can help you like build a financial literacy, financial knowledge. And once you start like digging into the work of this, and I'll get it more into what that means too, it is really just like finding everything. You don't need to be subscribed to, I know there are a lot of services. You don't need to have a Bloomberg terminal and $2,500 a month. A lot of that is for people who are trading or selling a large volume of stocks to very specific clients, and they have to like communicate with each other. And for this kind of activity I'm talking about, it's not necessary. You just need access to like publicly available information, which you can get through some paid services or through for free, either from the company itself or from like Yahoo Finance. There are a million services these days, some of which have really nice UI and all of that. So you're welcome to use whatever one you prefer. Not only like reading the 10Ks and the 10Qs, but I like to just dig into every little bit of news about that company. I like to look into who the executives are. I like to look into like anything they've written or worked on before. I like to look into if they're on Twitter, if there's like news about that company, if like what kinds of things are they spending their time on. I like to look at the products. I'll like research the products, of course. And like the example I've used before, because it's pretty clear cut, but there's so many. Like Tesla, of course, has done really well, and people could tell, for instance, there were like cars on the road and it was going to do well. But like a company like UPS, you see a lot of deliveries and you look into it. There is obviously no gigantic failing going on at UPS, but the price goes like that, because until you know for sure on the earnings day, the event itself, hence events-based trading, the price is just going to like incorporate that uncertainty and therefore remain low. But on that day, the uncertainty is dispelled, so the price assumes like the high price is assumed, which is like the correct price given how much business they're doing, and of course like the demand that people want to participate in that stock's future. So I would suggest just like an experiment for you guys, and let me know how this works out. And I will do this too. I'll do a separate video where I do this for next week. Okay, I'll do that. 5 stocks, and we'll see how each one of them do. And I'll pick one that is that I want to trade, and I'll just share it. You don't have to, but of course, I would like you to do the same thing though. Just check out the earnings calendar for like 3 weeks out. Go through every day and find one stock that week that you know something about, and dig into it. If you find out that you don't think it's going to like do anything exciting that week, then pick another stock from that week. But find the stock that you think is going to possibly do like pretty well or has been doing pretty well, because of course earnings are retrospective in that day of the earnings, like say August 20th. It's about like how they've done the preceding couple of months, the preceding quarter. So you don't have to like get a satellite and check out if Target has like enough cars in the parking lot, but there's a lot of information online about any one company, and you can look up whether there's interest in this company, whether there's volume, and it's like free money in some sense, because a lot of these, like I said, are obvious. And what does obvious even mean? It means it's like clear in front of you, like it's just no doubt about it. And I think that's like a good way. And you read through the 10Qs, and the 10Qs will tell you a lot. You read through all the reports of a company, and you don't need to like obsess about their EBITDA and any of the like the numbers per se. Although you really do want to focus on the growth prospects, the possible like challenges a company has. They are like, legally supposed to tell you this stuff. Like the CFO is supposed to say this, and the lawyers and everything, they're supposed to write this up. So, and they do. And you don't want any surprises going to stock. You want it to be like a low risk trade, right? You want it to be an obvious trade. So you can just like write off any like super risky investments from the reports alone. Just the company says, oh, okay, we're probably going to fail in like 6 months. And sometimes they say, really drastic things that like make you think that. And so don't trade that company, or if you're going to do, short it. And I'm sure other people have already. But if the company says, okay, we're going to do really well, we have like all these accounts opening up, we're like financially in a strong place, and you're like, oh, okay, this is great. And they're doing all the sales, and it's like a nice company, and people love it. Like their customers, whoever they happen to be, love it. And you look at the price, and it's like nothing. It's like, so you just, if there's enough volume, I don't want you to like trade like penny stocks. I wouldn't even care about that. But like $20-$30 stock, lots of like industrial concerns like this. Lots of smaller tech companies are like this. Like a lot of chip companies are like this. Depends, like some consumer companies here and there, everywhere. And overall, what you think is happening in the economy, you think is like the economy booming. You believe that? You believe that like people are buying and selling, like consumer spending is up, like trade accordingly. If you don't believe that, you might be wrong. There's like true and false, and then at the end of the day, like the world is not just like based on your feelings. So you've got to make sure you have like the correct set of facts. And if you do believe that like some company has everything it takes to like do really well, but they're not doing really well, you look into it a little further. And if there's no reason, you can't like find that this company sucks, and you ask around. Of course, you can go on Twitter, you can ask me, you can ask other people. I'd be happy to respond. Like, by the way, there's like hundreds of companies I'm like looking into. Like, I have like little reports written up and stuff for myself. I'll let you know what I think. I mean, no financial advice or anything, but I'll probably just like look into it myself. Then you trade that company. So we'll just look here. I'm on. Sorry, I had like shoulder injury, so I'm in a brace for a couple months. Yahoo Finance. I mean, I don't know. Yahoo Finance is not my favorite, but honestly, that company Earnings Whisper, I like those little informatics they do. So I think, these calendars, I think they published them on Twitter. They're really nice. They should do them. They should like generate them as much as you want. Okay, let's see. August 23rd, 2021. Very good companies. This is next week. Tuesday, Best Buy, Nordstrom. Those are companies I'm sure most of you have heard of. There are companies some of you have also heard of, but that aren't as well known, and I'm sure they're here too, like Advanced Auto Parts, Toll Brothers, City Strike, BMO. Wednesday, Dick's, Salesforce. Okay, Salesforce is right there. A lot of companies in corporate America are doing really well these days. A lot of companies that are doing sales are doing really well these days. Salesforce is used by most, if not all of them. So Salesforce is directly something I would be interested in. Box, something I would be interested in. Just because it's cloud storage, and a lot of companies have Box. A lot of startups have Box memberships. Splunk, Autodesk. Autodesk I would be interested in. So just to walk you through, I'd pick out Dick's, Salesforce, Ultra, Autodesk, Box. And then that's when I start digging in. So let's look at what's going on with Salesforce. You can make 10% on options, easily on options during like earnings. And that's good money, That's really good money. All right. Stock price, CRM is $256.13. All right. Look, as I said earlier, it's already been going up leading up to earnings. So, you ever look at the stock chart and it just goes like that. There are points like the earning events are where a lot of the action happens, and the other part is just like, okay, earnings, okay, we sold, we're fine. Earnings, that's the natural progression of a stock's price. Unless there's just like all this coverage and they're doing well, the other things might be happening, and vice versa if they're like getting bad coverage. But look at this. So if you had done what I had just suggested, like you don't have to, you don't have to have like foresight into every little thing, but rule of thumb, 2 to 3 weeks before. It's August 20th, yeah? So let's say August 13th through 17th, you had decided to buy some. Chances are you would have bought it around like 5% cheaper. That's good money. That's money you're leaving on the table, because on the 23rd, I think it's obvious to me that Salesforce is going to do pretty well. And they'll probably go up like 5 to 6%. They're not going to go up like 80%. They're already trading like pretty high. And I don't mean that like they're too high or anything like that. I don't really know if there's such a thing, but they are already there's already a lot of interest in them, and people who are interested in them have already bought it. But it's a famous, important stock, and I'm sure it'll be covered. And the moment it's covered in the financial news media, other people will also buy it. Yeah, I would have bought this. I didn't, but I would have bought this sometime like in the last 3 weeks, at which point it ranged from 240 to 252. So if you had bought any of that, you'd be making like at least 3%. If you say you bought 252, it's 256 now. That's like 3% that you left on the table right there. If you had bought, let's say you got lucky and you bought 240s, that's another like 10% right there that you could have added on with your how it's gonna go up. So I might as well like air this, because maybe I'll buy some right now. It's probably like just for fun, like maybe like 10,000 or something of Salesforce. But all right, so Salesforce, we know a little bit about. They make like these really nice platforms for companies to like manage sales and manage leads. Here we go. Is it too late to buy a Salesforce stock? A little bit, but not really too late. I think Salesforce is going to do better than the analysts are suggesting. I really think that. I think that because I know that a bunch of companies are being funded these days. A lot of companies are like increasing sales. Like in corporate world, like business is good, so Salesforce is going to profit from that. Like people making money selling their companies, like software enterprise, like anything, right? A lot of them are using Salesforce. They're using Salesforce, or they're using some sort of offering from Microsoft. But here, let's look at Box. I'm sure Box is doing fine. I gotta add some informatics as well. I'll try to add that in when I'm editing. Box, it's been around for a while now. It's one of their first like really successful major cloud storage companies. With any company that you want to learn more about, just read the Wikipedia page. That's something. Doesn't make you an expert, but it's something. You can look through, like, it's created by Aaron Levy. Some people are concerned whether like if a founder is with a company still. Sometimes it matters. I don't know if it always matters. And he is, in fact, still the CEO. Blocks is a company that a lot of other companies are using, and they give Box accounts to their employees, or they so you can go on box.com, another good place to start. Read through like every little thing they have: products, content cloud, security and compliance, collaboration, workflow. These are their product suite. This is their product suite. These are their solutions. A lot of their websites typically geared towards their potential customers and maybe possibly like investors and media, but mostly their customers. So it's like marketing their company, showing what they do, how they make it, how how their business works really. So I would read through this as much as you can. Look at the pricing. I don't know how many individuals are buying, but free for individuals. It's really nice. Up to 10 gigabytes for free. And integration with Microsoft and Google Workspace. So you can do that, but I think they're really doing well with the business. And so next thing you'd want to do, you say, okay, Box might be cool. Let's look at the price. I like box price. Yeah, $24.63, and that's about like where it's always been. You know, Box is a company that has like pretty steady deal flow, so nothing like super surprising is happening with Box. If you read their reports, 10Q, Box Inc. Honestly, I wouldn't trade Box. I think it's a great company, but I don't know if it's for me. You could always buy and hold this. A lot of these brokerages are, you know, back in the day, if you look into, you read any like memoirs or any like finance, like trading books from the 80s or 90s or earlier, and in that era, big concern people have thinking about like the well-being of retail traders is whether you know, you're being screwed by or whether you're being taken advantage of by the like commissions that brokerages are charging. You might be you might be affected a little bit by deal flow that brokerages are selling. Some of them are selling now, but it's nice that there are free no commission trades. In the sense that you put $2,000 in Box, it goes up 4%. You know, I don't know about you, but that's fine. That's good money for me. You know, lunch money at the worst, at the very least. So you don't really have there's no cost to doing that other than, you know, had you found, and if you had found something that you really wanted, that you thought this is going up 20%, this is an amazing company, or like, you know, that like you, I keep going, like, you know, something about like a biotech company, and you've read like the research and you think the trials are going forward, or they have a really compelling solution to like a disease, then yeah, by all means do that. But if you're just sort of like hanging out that week, you don't have anything like that really makes you think, that really draws your attention, 2 to 3%. I think the stock will go up 2 to 3%. That seems very obvious to me. Yeah. Look, is it too bit late to buy Salesforce stock? Motley Field. I by the way, I'm not like a big fan of like reading this stuff like daily, religiously, any of that. But if you have a stock you're interested in, search up every article you can find on that stock, all of them. And if you find that you just can't concentrate or something, whatever, you know, this is the work. You should just read through and like write notes on it if you must. And not every article is, you know, some of them are computer generated, and it's quite obvious. But you just read through it. Sometimes you pick up little tidbits. You know, a lot of analysts are smart and they write what they say, but I wouldn't like trade on that basis. Usually I would just do my own research, which is in fact what I do. And I hope that like that's the kind of trading that I like to share with people. So 320 target for JMP Securities. Okay. And the price was CM. Yeah. My arm. All right, let's go. Yeah, 256, 3. But you know, you're concerned about like events-based trading. You want to like make money on this pretty like quickly. I'm sure it'll get to like 320 in a couple of years, possibly. You know, that's the kind of thing that some analysts are concerned about. They're not like trying to make you a quick buck next week per se. But both of these stocks are going to go up. And I've actually read through like a bunch of Salesforce reports, and it's a strong company. It's really well led. So is Box. Both companies are going to do pretty well. But what else is here? Ultra is interesting. Ultra is interesting. My intuition is Ultra is going to do pretty well too, but let's look into it a bit more. Ultra makes like they have stores and like malls, and they make it's like a makeup, shampoo, that sort of store, beauty supply store, and they're always popular. Whenever I go to the mall, I always see people going in and out of Ultra. Sometimes I think they do like special events where like people can do makeup there for free, or I don't know if that's how it always is. Yeah, look, net sales go up like 9%. last quarter. What's going on? You know, are people suddenly not interested in having makeup? I don't think so. You go on YouTube or something. Some of the biggest channels are makeup channels. A lot of stuff they recommend or sell, you go to Ultra to buy them, or you order them online from Ultra. And Ultra has actually done really well. If you go on their website, they don't really even need a store anymore. They are like completely adapted, completely in sync with the whole online shopping world, and they have been for a while. So they're like steadily doing well. So I would buy Ultra too. I would buy Ultra. What else we got? Wednesday, we got. I mean, those are the obvious ones that like I think most of you have heard of. But so the cool fun thing is some of my best trades is like Elastic, Pure Storage. You dig into these companies, and a lot of them are going to be like very exciting. Some of them are going to be not, but this is the work. You know, this is why you work. This is how you work. If you want to trade this way, Dick's Sporting Goods. I doubt Dick's is going to be like, you know, pumping cash, but it's a strong company. They do fine. I think they have like less stores now than they used to, but a lot of people go, it's nice in there. Thursday, we got Peloton. Okay, that's like a big one right there. Peloton's going to make money. Dollar Tree is going to make money. TD is going to make some money. Gap's going to make... HP and Gap are going to make a little bit of money. Is that Marvel or Marvel? Marvel. Yeah, semiconductors. I like semiconductors as an industry myself, but they are not always like amazingly profitable. Good semiconductor business is, you know, they have a good deal flow. They have like established position in the market and a lot of customer relations, and that's where they stay. Then there are like the occasionally like really sexy ones like AMD or something, or Nvidia, and they go up and up and up. But Marvel is a solid company. It's a good company. But I don't think that anything new and exciting is happening with Marvel that would... or maybe there is. You look into it. So they're going to buy Innovium for $1.1 billion. Well, we look. Innovium. It's TechCrunch article. All stock deal. Good company, makes networking and Ethernet switches. Optimized for cloud. Yeah, but Marvel's been around for a while as well. So here they've acquired a networking hardware startup, Innovium. Company had raised money on a $1.3 billion post-money valuation last year, and now they're selling for $1 billion. $1.1 billion. That's interesting. Is this like business as usual for Marvel? You know, let's look at the Marvel price. Yeah, it's been going up, but not much. It already went up when was this announced? This was announced 3 weeks ago. 3 weeks ago, the price was... Yeah, 3 weeks ago, the price went down after going up for a couple of weeks leading up to that. All right, you look at like May, you know, about a year ago or so, Marvel was like, it's like steadily improving. You know, this is like a healthy growth for any company. It's not exactly as quick as, you know, stuff that gets me excited when I look at a company, but it's a very solid company. I would like own Marvel just to hold. I think they'll be doing fine going forward. Founder Sehat Sutarja. Yeah, there's a building named after him at Berkeley. I don't know if that's him though. There's another Sturja. Is it him? Yeah, Sturja Dai Hall. Yeah, Sturja Center for Entrepreneurship and Technology. I thought that was like the Qual. No, there's another Qualcomm building. No, yeah, I know where this is. Let's see if they explain who it is. They don't like to talk too much about the donors. It's like, give your money, bye-bye. And then 20 years later, they like even take off your name if they can do it. I'm sure he gave quite a bit of money, but probably not the entire like funding for that center. Yeah, I would own that. I would own Marvel. Like, if you're trying to build like a small portfolio, which should not necessarily be what you're interested in my view. You should be interested in like growth-based trading, not necessarily if you're like managing your wealth. There are worse companies to hold than Marvel. Marvel's not really going to go anywhere. They're not going to be superseded. They make like pretty specialized products. Like, it's a concern with any like technology company that potentially they start becoming like legacy tech. So some of them, what they do is they go on like acquiring binges, and unfortunately sometimes I'll wait until this process sets in and then they acquire, but a lot of them also just are acquiring throughout their growth and the maturity in their market position. A company like Amazon, Facebook, and all of those, they're almost like constantly acquiring companies. I think Facebook only acquires like VR-based companies these days, but like Amazon acquires quite a bit of companies. Apple acquires quite a bit of companies. But they're like very professionally managed, gigantic companies, of course. But even like smaller but sizable like tech companies like Marvel, which are like doing really well, they're acquiring quite a bit of companies, but a little bit more than they used to, which should make you think. Some people, I guess, potentially could ask, what's going on with that company, but who knows? It's not like a red flag or anything in my view. It's just business as usual. Yeah, okay. I would like Ultra. Ultra is like, you think about like companies that do really well in retail. What's the first company that comes to mind? For me, what's the company that makes those leggings? Yeah, you know what I'm talking about. It's the... Why am I blocking out? Oh, Lululemon. Yeah, Lululemon is like star of retail of the last couple of years, and rightfully so. Ultra does well. It's not Lululemon, but it does well. The day after, let's look. Thursday, Peloton. Yes, that's where we were actually. Peloton. I would buy Peloton. Peloton is not just a meme, as people say. People are buying Peloton. It doesn't really need to be. Yeah, I would buy Peloton, no question about it. I'm confident Peloton is going to go up like 5 to 10%. That's enough. A lot of these guys on like some of these online forums are like, oh, I made like 2,000% a week. Awesome, dude. That's awesome. And you should make those, or you should endeavor to make those. But you want to, pick up a little on the side here and there, like grow a nest, grow like a nest egg, grow some money. This is how you do it. 10, 20% here and there, it builds up, and of course it begins to compound over time as if you continuously grow your portfolio. Yeah, Peloton, again, like the reasoning, everybody's kind of like sort of staying at home, a little bit more interest in active fitness. It's a tech company. It's got like good marketing. It has like, they sell these at Lululemon. A lot of people shop at Lululemon and they buy like $400, of leggings or shirts or jackets. And then there's like a Peloton machine next to them, and probably a little thing goes off in their head, result of the marketing, that why don't I get a Peloton machine? And then they go on Peloton website. Whoa, Peloton's website's pretty cool. You can even buy one of those mirrors, and then next thing you know, you have like this personal trainer at home, Peloton, and it's a whole subscription-based service, $50 a month. You get classes. There's an app. Like nice setup, and it's a trend that's like, it's not just confined to Peloton's business model. A lot of big companies, so to like validate the market here of Peloton and like home-based training, Apple has like started to do this sort of thing, right, with the whole smartwatch, and they're doing the fitness subscription. If you buy one of those like Apple ones, you get it even if you don't use it. And okay, Peloton's gonna be my to go for this week, because I think they're doing really well in sales. But let's look a little bit more into Peloton. So this is just an example how we would work. Normally I had like my big screens here, but I'm trying to like not injure my arm. Yeah. So okay, let's look Peloton 10K. Just read the one for the last quarter. You don't have to be like 8 hours a day on this, but usually you're looking for red flags in one of these. You're not looking for validation of your trade as much as you are looking for it to be invalidated. You're looking to like, falsify your thesis if you could. And if you can't, that's good. Just stick with the trade. But, it's illegal for them to omit any important like material fact from these reports. So everybody is like a nice moral or legally law-abiding executive, of course. So they add in things that are relevant. And so you should read these. Okay, yeah, here we go. Also, another thing to look at is like stock sales or like executive changes. But Peloton is not going to be a company that has like a lot of drama in the C-suite. They're making a nice higher end fitness consumer product, and it's selling. And it's also a technology product, and with a subscription model. So that's a lot of where the growth will come in over time. And that's also why the price will reflect that future projected growth. And for you, and for me, for anybody who trades it, that will manifest in a higher stock price and more profits over time. So this whole like idea of just like buying and holding like a nice stock, it's a respectable way. There's nothing wrong with it. But what I'm like a little bit more interested in is like get these stocks as they're going up, like profit off them, and like keep moving on, keep doing that over time. You can like build a lot of build like some strong assets that way. Peloton 10K SEC filing. So any website, any company has like an SEC filing section. Well, I don't know why I can't view. Oh, these are okay. Let's look. They had some changes in beneficial ownership, which means people bought stock or they issued some stock. All very typical. Most of their announcements are to this effect. So look, if the executives are selling a lot of the stock, they have to announce it. And first of all, they're making money and they're enjoying their lives. But for some people, it could possibly be theoretically a red flag. I think that's rare, and that it's pretty obvious when it is. You just get like there's probably some news item to accompany those, but some companies are like under the radar. Like I don't think Peloton's being covered every single day. This looks to me just like executives and first of all, like employees being rewarded with stock. Yes, I see that, and some executives selling stock. People people got to buy a yacht. You want to buy a home. How much home prices are in California. Where's Peloton based? Is it New York or California? A lot of these fitness companies are based in like Canada, like Lululemon is from there, I think. New York, yeah, it's New York. So you know how much a nice house in New York is? It's not cheap. So a lot of these executives, that's just regular business, regular life. I have a kid go to college or anything, right? So these are all statements. Finally, we got a report here or something more exciting. Oh, look, we can filter. So you got an annual report last year, and that's because they are a relatively new company in terms of being public. They only went public last year or 2019. Yeah, look at this. Fool.com. If you invested $5,000 in Peloton's IPO, this is how much money you'd have now. 100,000? How much is it? Skimming this article. Well, it's $21,000. That's good, but I don't know, the way they made it sound, I thought it would be more. 10K 2019. All right, I'm going to read through this for you guys. Yeah, okay. So like any piece of literature, the more, of the genre you read, and let's say this is the genre of SEC filings, the better you get at understanding them. And if at first they seem like incomprehensible to you and you cannot, pierce through and get like useful insights from it, stick with it like any other thing. Just read more, and then eventually you'll find that you do understand them. Some of the, this is all like an aside, but occasionally there are like very interesting financial instruments here, like special types of options, special types of like insurance policies that companies take either to like entice their like executives as part of like their commiseration package, or there are like things that they do to like hedge themselves against like changes in the market. Not every company does this, but that stuff, if you do encounter them, like that can be difficult. If I see that here, I'll discuss them. There are a lot of cool things you can do with insurance and like special options and special derivatives products. And companies do them, and that's what a lot of financial engineering is about. But some of them are like standard by now. So yeah, okay, just disclaimer, part 1, largest interactive fitness platform in the world. Loyal community of 3.1 members. They pioneered this. Okay. Yes. Fun, social. Yeah. Okay, look. Connected fitness products. The Peloton bike. And the Peloton thread. What's the tread? Oh, yeah. So they have like a running like thing. And then they have that's a tread. And then they have the bike itself. And the recurring subscription service. Very nice, very nice. 113% in fiscal 2020. Sales have grown. The subscription base is where they're going to make a lot of their steady cash flow going forward. They're going to sell the bikes, but every bike is going to be a subscription that's going to be paying, hopefully for years, right? Or at least until the next quarter. Okay, this is like the basic stats here, the basic data. 1.8 billion revenue. 915 million and 435 million. Wow. So those are like their growth over time. So they go from 435 million 2018, 915 2019, 2020 1.8 billion. So doubling every year. This is a company you'd want to be invested in. At one point you might like think, is there a theoretical like ceiling to Peloton's growth? Who is Peloton's potential like customer base? Like the body of every I don't know, adult, children maybe, like anybody who can like ride a bike or wants to, right? And is willing to spend enough money to do so, is willing to invest in their personal fitness and looking good and being healthy. I mean, that's a kind of a like market that they're like trying to sell to, of course, and they seem to be pretty good at it here. And I don't think they've exhausted that market by any means. So you look at this. This is what I would think. I look 2018, 435 million. 2019, 915 million. 2020, 1.8 billion. I gotta think like 2021, right? This is what I'm thinking. Like the preceding year now, have they been doing as well, if not worse? Excuse me. Are they doing as well, if not better? And just like intuition, of course, just like off the top of my head, I would say they are. They probably are, because you would know if they are collapsing as a company. And so assuming that they're not completely in some catastrophic set of circumstances where their growth has gone from like 100% or more every year to like zero, they're doing something in between 100% and maybe even a little bit more, or maybe even a little bit less, but in that general range, right? And that's enough. That might not be enough for like a spectacular earnings beat and going forward, but it's enough to know that they're not going to like collapse as a company and they're making good profit. Okay, and they're making profit. Finally, like last 2 years, they were losing money, $30 million in 2018, $70 million in 2019. 2020, they made $117 million. This is really good. This is very, very good. And it's like a nice narrative. It's a good story. So it looks like I could spend like an hour on this because it's a long paper. But the gist of it is that they describe all of their products as the people who have manufactured them. They're in a good position to do so. They describe them in sufficient detail for an investor, which is you. And so you do need to read that. And the part which is really exciting is where they talk about some like potential outcomes of the future, like how their business could be adversely affected. It says like if there could be an accident, a safety incident, workforce disruption. Some of these are standard if you have a factory. Seasonality. Yeah, so their business has been influenced by seasonal trends common to traditional retail selling periods. Yeah, like people buy like around holidays, New Year's, cold weather. Interesting. Yeah, like think about this. This is a company based in New York. Soul Cycle and all those things are fun, but or even like cycling on a physical bike. But imagine that like you cannot do that all every season of the year in New York. You could probably go to a class, but this is a class at your home. So I see the point of the product, and I think it's a nice product, and I think that's if I think that, I think a lot of people might think that too, and not only for that reason, but because I think I can tell that they're marketing this well. It's a well-run company. So okay, this is more interesting. The prices might go up because here they go into it, increasing component costs, long lead times, supply shortages. I do not think that Peloton is such a product that if it goes from like however much it sells for, which is like $1,800 to $1,900, that their prices are that the sales are gonna decrease by like any sizable measure. It might decrease a little bit, but I think people who are willing to spend more than $1,000 on a Peloton bike are willing to spend like $50 more, $100 more. So I'm not too concerned about it. Seasonal demand is interesting. So you got to think about this is a quarterly report, right? So, okay, we're in August. So what was like the preceding 3 months? Like what quarter was that, right? Okay. It's not going to be like the highest sales probably because, they described here that their best sales are during the holiday season. But I'm sure it's not going to be bad. But if you were to like trade this like Q4, yeah, you might do a little bit better. The price might go a little bit more. And of course, people would forecast that. But like I said, you got to buy it earlier in anticipation. And you have an eye on a stock, you buy it when it's cheap, anticipate the event in which the price will begin to increase, and then you sell. If you want to be like a person who invests forever, be my guest. But that takes a little bit more time and patience. Yeah, okay, so they're collecting a lot of data as well, which, they're concerned that there might be legal obligations and rules and regulations related to security and privacy from like a lot of people in the United States and in Europe are talking about this now. I think Europe has legislated some new privacy protections. But, I'm not worried about this either. There is a method to this. They ask you can like opt out, all of that. And if anything, they can like they can tailor some products specifically to their users. So there's potential there for even greater sales, greater product adoption, more product lines. Sales and taxes, these are very typical. We might be subject to more sales, and we have to keep those in record. That's what they say here. New taxes. There's talk about like new taxes like overall in corporate America, but I mean nothing concrete so far. So I wouldn't be too concerned with that. Economic downturn. Yeah, generally every company discusses this, and sometimes in some reports, genuinely they have like interesting insights. But I do not believe that the United States is gonna see like a financial, economic like uncertain period like in the next couple of weeks. Good, another one, like their credit facility may restrict their operations if they do not effectively. So they're saying if we're bad at our business, letting you investors know if that we are bad at our business, then our bankers might not give us as money enough, the money we need to grow. So letting you know. Well, then I don't think, I'm not concerned about that either because, presumably they should be good at their business or try to be. We may engage in merger and acquisition. Yeah. So they might buy some more companies. This is interesting. Peloton could buy like some other startups doing something similar. They could build like a whole suite. They've acquired a company already. So Peloton is always like, I think they're like gearing more towards like subscriptions and music and like trainers. So they've already acquired like a company that does music that, instructors can use to curate, I think like playlists that you can get like a special playlist from your instructor. A lot of the cycling world, like the sport and athletics of cycling or the exercise of it, the class, a lot of it's music driven. So, I mean, that's a clever acquisition for them. I don't know how much money they spent on it, but the concern here is that they might have a bad quarter if they have like a acquisition they have yet to fully like incorporate into their business, or if their management is distracted with that acquisition and then just like shuffling teams. They only have so much attention span. Payment risk, yeah. Foreign policy fluctuations. This is a little bit of concern because I think they do have quite a bit of sales in Asia and Taiwan and other places, but not much. And these are not like extremely volatile currencies. Okay, this is fun. If our estimates or judgments relating to our critical accounting policies prove to be incorrect, our operating results could be adversely affected. They all put this in, but it's funny. The fact that they put it in is kind of humorous to me. If we are wrong, like we've made like we're incompetent with our accounting, then and that comes out, then our operating results could be like adversely affected, right? We could end up doing like worse because we have to like either correct the faulty accounting or like pay some sort of damages. But it's just kind of funny that they put that in there. Yeah, all very typical stuff, but let's look at the very exciting stuff here. Okay, EBITDA margins going up. That's not the only thing that concerns me, like if I'm like trying to make a decision here. But right now, I think this is a good success of the company, and the financials here corroborate that feeling based on like my reading here, and the feeling itself is based on my analysis here. Like it's my conclusion. Yeah, okay, music royalty fees. Again, these are like established businesses. Nothing like drastically different is going to happen in any of these. There's some costs associated with like advertising and all of that revenue. Okay. I would now start looking at like, let's find like a trading view. So like, I just want to like check out like, has it been trending upwards? You can use any little company you want, a software you want to look this up. You can even do it in your broker like E-Trade or Fidelity or something, or Robinhood. Let's go on Robinhood. I think I have a Robinhood account. I had a Robinhood account when I was in school. Like I've had Robinhood since like early beta. But I don't know if I go on it much. But whatever you use, right? So here, let's go on TradingView. They have like these nice charts here. Or I have Yahoo Finance already up. All right, so I'm gonna trade Peloton. Actually, I'm gonna buy some options, and depending on what the prices are. Only thing that would concern me here is volume. Wow, just today it went down like 5%. Yeah, I think it'll go up like 5 to 6%. It's not gonna go up like a lot. But let's look at what other people think. Let's look at the news. They're gonna get a rowing machine. That's kind of it. Yeah, they already discussed that in their paper. Are they big on BuzzFeed and influencer? And it's getting to a point where, you know, it might be good, but it's really not obvious to me now. I don't think it's like a horrible company, but it's not obvious to me. I might like buy and hold this. I don't know if I would buy like too many options on this actually. But I would. So next week, I think I'm going to buy a little bit of Ultra. I'm going to buy like some Salesforce. I'll buy them on Monday and then just like wait and see what happens. Though normally I'd like to wait out a couple of weeks ahead, but I'll post the results here. See what you guys think. Okay. Thank you. Have fun.